So in this video, I'm going to tell you a story, a true story, that illustrates two incredibly interesting and surprising phenomenon I've observed over the years in the investing and trading world. The first phenomenon is the strange reality that sometimes the best investors and traders really do not understand why they are successful. It can actually be very difficult sometimes to tell the difference between luck and skill, even among those that are successful. The second is the incredible importance that exits and proper risk control, really you could call it investment or trade management, play in your long-term success as an investor or trader. So the best way to illustrate this, I think, would be with a story. And this story is a true story. I learned of this story many years ago from an old trader named Chuck. So Chuck had started his career as a commodity broker for E.F. Hutton, one of their flagship offices, which was a large office. They had installed these flip card kind of clapperboards that would show price charts. Chuck said in front of him were about half dozen comfortable sofas that were facing a nice mahogany wall that had the clapperboard on it and these ticker tape machines that were constantly producing, updating price information. So there was a kind of a gallery of traders that would sit there. They were known as, they called them old timers. And these were traders that sat around and they would trade futures contracts on real commodities, things like pork belly, gold, grains, oil, etc. They would lounge around on these real soft sofas, just talking, bantering. They would draw their price charts to plan out their trades and so forth. A lot of the time they would arrive early to the floor, spend a little time preparing for the markets open. Usually they all had kind of their usual spots that they all prefer and begin the day of trading. And overall they enjoyed the elegant atmosphere. It was kind of a mystique and so forth related to this world. What was really interesting is one of the old timers kind of kept to himself. He wasn't that social with the other traders. He didn't really spend a lot of time with them. He kind of stayed by himself and just kind of hung out. He would spend his time intently watching the price changes on the commodity boards. What was interesting though is he carried an old glass Coke bottle with him. And sticking out of this Coke bottle was roughly a 12-inch broken radio antenna. And occasionally, Chuck said, he would whisper to this Coke bottle. And everybody would take notice of this. Again, this is before the times of cell phones, so kind of keep that in mind. Nobody knew what he was doing. It was very unusual. He would whisper softly to this Coke bottle, and people would try to listen in, but they couldn't really hear him. They couldn't understand. It was too quiet. Well, it turns out this trader was a client of Chuck's. And he would, of course, this trader would occasionally come to Chuck and make a trade and go sit back down. Well, this room of traders were curiosity got the better of them, and they began to very much ask Chuck to figure out what was going on, what was with the Coke bottle. Chuck finally agreed one day, said, yes, I'll ask him, and he got a chance when this gentleman came back, the Coke bottle trader came back to trade again, and Chuck entered the trade in successfully. In passing, very politely asked the man, what do you use the Coke bottle for? This man stayed in completely serious, not embarrassed at all with this. He said that this was an intergalactic communication device that was given to him by aliens. He told Chuck that the aliens were very interested in our commodity markets, and they would often give him trading advice from their various observation points on other planets. And apparently at that moment, he had actually said he just got a message from Mars and that they were going to buy soybeans, so he started to buy soybeans as well. And after revealing this, he went back to sit back down and began his quiet conversations with his Coke bottle. Of course, Chuck revealed what was told to him, and as soon as that happened, everybody immediately paid attention to this Coke bottle trader and the soybean market. In this case, the soybean market immediately went against the trader, and eventually had to close out the trade for a loss. As you can imagine, the other traders had no sympathy for this guy. They were quick to begin to ridicule him and his beliefs and kind of make fun of him. However, this Coke bottle trader's very next trade actually turned out to be a huge winner. If this video has been interesting, let me know by hitting the like and subscribe button. And so he started going around from sofa to sofa, talking to everybody, telling his story, and pointing at the clapperboard while he was waving his Coke bottle with the antenna in it, bragging about the profitability of his most recent message from outer space or wherever it was. Of course, his previous critics had to endure his bragging about his success on the current winning trade. Several more trades were made. Some were winners, some were losers, but a very clear pattern had started to develop. And that was that this trader, whenever he would have a losing trade, he was ridiculed mercilessly. But whenever he'd have a positive trade, he would get his revenge and have a last laugh during all of his winners. This trader might have been crazy, but he wasn't stupid. He did not want to be made fun of, and he enjoyed the fact he could brag when things were going in his favor. So what this had a tendency to do is he would cut his losses short, and he would let his profits run, simply because when he was winning, he wanted to stay in his profitable positions as long as possible so he could continue to brag to everybody, and it was a way to defend himself from the ridicule that he knew he was going to be foisted upon him if a trade went against him. As long as he was sitting on a sofa in a winning trade, trade, nobody could say anything to him. And to him, he would display his profits that he had in his trading account as hard evidence that his ideas were working and that he really was speaking to extraterrestrials through this Coke bottle. So this pattern of ridicule and bragging and back and forth continued for several months, but what was very interesting, Chuck said, is it became very evident that this Coke bottle trader became the best trader on the floor. And this was entirely accidental. It was not because he was talking to some aliens. It wasn't that his entry strategies were any better than random. It was that he was inadvertently using excellent exit strategy. By cutting losses short and letting profits run, he essentially stumbled upon the trend following philosophy that has been proven to work over many decades. His entry strategy was no better than random, I can assure you of that. But his exit strategies were far from random. In fact, they're very well documented that these types of exit strategies work very well, especially in very trendy-like markets such as commodities. And I'm sure at that time in the 1960s, commodities were trending quite a bit because of the Vietnam War, the amount of money printing going on. That has a tendency to create a lot of trends, and trend following works very well during those times. What's particularly notable, he was doing significantly better than a lot of traders with more sanity who were also trading on that floor at the same time. So this illustrates a very important factor in the investing and trading world. Sometimes the most successful people really do not know why they are successful. They would not be able to repeat their success in other situations. You could call it luck, or you could call it inexperience. Don't get me wrong, there's definitely a lot of successful investors and traders who very much know why they're successful and are very good and can repeat it many times in all kinds of different markets, all kinds of different market conditions. But sometimes you would be surprised, some just do not know why they're successful. I've talked about this before in another video. I did see this at the hedge fund a little bit, where sometimes people would be successful and not necessarily know how or why they were. If there's anything you're unsure about, leave a comment and I'll answer it for you. Of course, the second part is that exit strategies, or broadly I would like to call it investment management or trade management, which includes exits, but there's other techniques such as you could use options contracts. In the case if you're, let's say, buying businesses or buying real estate, you can use things like earnouts or seller financing, a variety of different ways to lower your risk and control your risk. Exits are just one of many different ways to essentially manage your risk once you've gotten into an investment or trade. And that management, you can call it risk management or trade or investment management, is actually where most of the profit really lies with most investing and trading systems. So for example, let's say you go out and you buy a company, and that's one form of investing, Warren Buffett style. Now, the setup and entry to get into that company may take a lot of work. You may research a lot of things, do a lot of stuff, try to find the right opportunity, priced right, and so forth. But once you've acquired it, how you manage it after the fact will have a much broader and more powerful effect on whether or not you're profitable in the long run. For example, you may get in there and your first strategy may be to change everything this business has done ever, okay? Alternatively, you could get in there and just leave management in place and not mess with anything. My research has found, in my experience at this example, because I do know this, in the case of business acquisitions, if you go in there and change everything after you've bought it, most of the time you're going to ruin the business. You're going to goof it up, you're going to upset your employees, people are going to leave, you may upset customers and so forth. You're far better off leaving things as they are, leaving management in place. This is what the research shows, this is what experience shows, and so forth. Now, my point in this little example is that how you managed it after the fact was far more important than worrying about all the details about buying exactly the right business at the right time. Sure, that can add some benefit, don't get me wrong, but it's much less important than how you manage the investment after the fact. So over the years, I've had experience of testing a lot of different trading and investing strategies. What's been very interesting to me is I could take a variety of entry strategies and pair them with the same exit strategy. The results would be incredibly similar for each one. Okay? They would all have a lot of similarities to each other. However, if you take the same entry strategy and use a wide variety of exit strategies, you're going to find the results for each one are vastly different, directly coincided with the different kinds of exits. The exits have a tendency to have far more importance and power on your long-term performance than your entries. So the reason this is so important is a lot of investors and traders will spend weeks or months, years, analyzing and trying to perfect the perfect setup and entry. And in many cases that can be helpful, but it really doesn't get them nearly as far as if they spent that much time perfecting exit strategy. So here's some tips. It's just going to take a lot of experience, time, and research to start to figure out why you're actually successful. Over time, you will start to see patterns. Over time, you will start to figure out, tweak things, experiment, test different systems, invent new systems, backtest them, and you will begin to see a pattern, what works and what does not work, and that will allow you to begin to understand the true reasons you are successful. The other tip is do not ignore your exits or your trade or investment management. That is actually far more important than most people understand. You really need to design that. And very similar to my first tip is you need to gain experience experiment, try things, read, spend a great deal of time learning this process. And I really recommend experimenting. I really recommend people to design systems. If you're going to trade the stock markets or currency markets, commodity markets, crypto markets, whatever, you can do a lot of back testing using charts. You can also back test using fundamentals. You do have to research this very heavily. You can research buying real estate if you're into real estate investing or business acquisition, whatever the case may be. You can research this stuff very heavily, and you can start to see patterns in the proper strategies and techniques you need to manage these investments and trades once you've gotten into them. If you're enjoying learning about investing and trading, then I really recommend this next video. Okay, everybody, that's it for me today. My name's Cody Koch. Thank you for watching.